All right. It has been a while since we've done one of these, the charts to watch. I have a list of tickers for you, specifically for stocks reporting earnings this week. Before we start, few disclaimers here. Number one, I'm not covering Apple and Tesla because we cover those charts in the regular program. And of course, Tesla reported earnings after the bell today. The earnings are impressive numbers-wise, but once again, the stock is extremely overvalued, so anything they report, it's already accounted for. Which leads me to disclaimer number two. Technicals is just one factor of what moves stocks up or down. You have the fundamentals, the valuations, the momentum, the money flow, earnings, corporate news. There are many other factors that determine whether stocks go up or down. The technical setup is just one factor of many. It remains an important factor, but it's just one factor. So keep that in mind when we go over these charts. Disclaimer number three. All of the charts we're going to go over right now were taken before today's activities. The majority of the charts we're going to go over are weekly charts, and I want to go over the technical setup before the start of earnings week. So keep that in mind. I'm not including today's activities in these charts. And with that, let's start with Google, the big Goog. Let's see how this stock is set up prior to earnings. This is a weekly chart. Of course, the stock is pretty much in a vertical trend line higher. A massive move, perhaps the best performer among the FANG stocks, the big cap technology stocks. Now, let me tell you a little secret here in this business, how money managers make their decisions. In the beginning of the year, I received a note saying that you should buy Google from a respected money manager, who also told me that this is the consensus among other money managers. You should buy Google, and the reasoning behind that, this is a stock that will start to work better as we head into reopening, but it remains a play within big cap technology stocks. So you'll have a hybrid play, a play on the reopening of the economy, but yet still maintaining a positioning in big cap technology stocks. Now, to my regret, I understood the consensus among money managers, but I did not follow the consensus. I did not add Google in my portfolio or any of my clients' portfolios. And look at where the stock is trading right now. Gains of over 50% in the first half of this year alone. So what do we do here? Where does the stock go from this point on from a technical setup? When we look at the weekly chart, it is highly extended. When you look at the RSI indicator, for example, the relative strength index, it is reading at quote-unquote overbought territory, meaning that this is a stock to sell, not to buy. Mind you, the RSI doesn't tell you any buy or sell signals, but it tells you buy and sell zones. And we are now at the sell zone, meaning that perhaps the best of the gains are already behind us. Likewise, when you look at the MACD indicator, you see all of these circles, all of these bubbles that I'm highlighting for you. These are all points where the momentum weakened and we saw a dip in the stock. Yet we saw a rebound in the momentum every single time. What does that say? It says that there was strong consensus among money managers and investors alike to buy the dip in this stock at any and every occurrence. Now, that could happen after earnings and we see another dip, but the stock at highly elevated levels. Once again, up over 50%. The best of the gains are behind us, and the setup is setting the stage for a disappointment, regardless of how good the earnings out of Google will be. Of course, the stock had a massive pop higher last week on the heels of Snapchat's earnings, but be careful here of assuming that the earnings from Google will match the success of Snapchat. Two different companies with two different capacity for growth. All eyes, of course, will be on YouTube's earnings, the growth of YouTube within Google. But once again, we're looking at the technicals, not the fundamentals. And the technicals say this is not a buyer stock. This is a seller stock. It's already overextended. The likelihood for disappointment is highly likely. Next, we have another big cap technology name, Microsoft, which happens to be the only big cap technology name that I own in my portfolio. I'm using the Bollinger Bands to illustrate something for you. A lot of technical analysts use the bands as buy and sell signals. I don't use them that way at all. I don't see the bands, the Bollinger Bands, as offering buy or sell signals. What they indicate instead is the strength in the trend of a certain stock. And as you can see, this is a weekly chart for Microsoft. Microsoft is already trading above its Bollinger Bands. This is an indicator for strong strength in this stock. And usually, when the stock trades at these levels, you're not going to see a massive drop. Instead, you see a pullback, some consolidation, building energy, and then continuing the move higher. Yes, the stock is overextended. From an RSI and a MACD indicator perspective, the momentum is extremely strong, yet it is not as cartoonish as the chart of Google, for example, leaving Microsoft's chart with a little more room for gains here. And therefore, my strategy is, as an owner of this stock, to sell the 300 covered calls ahead of earnings. And if the stock pops higher all the way to 300, I will be exiting the entire position, because at that point, the stock will be grossly overvalued. Another perspective for the chart, this is again a weekly chart from Microsoft. The chart has been trading within a defined channel, defined peaks and defined valleys. In recent weeks, the chart broke above the trading channel. This is usually a bullish signal, indicating that the stock will build on more gains. But remember, these are just the technicals, one perspective of what moves stocks up and down. The fundamentals will matter, because the earnings report, if this stock will move higher, it has to show significant growth year over year and quarter over quarter in the Azure business, the cloud business. Moving on to another chart reporting earnings this week. AMD, Advanced Micro Devices. This is a weekly chart. This stock has been consolidating in range for over a year now. Hasn't done anything in a little over a year, just parked within the same range. Why? Well, you look at the chart, the stock moved over 4,000% since 2016 alone, one of the best performing stocks in the entire market. Well, when stocks move higher to the tune of 4,000% in a few years, a lot of the earnings and the growth is already accounted for. Even though this company produces stunning earnings reports, pretty much every quarter, they have double, if not triple digit growth in the top and bottom line in certain categories. When a chart consolidates within range for a long period of time, it is waiting for earnings growth to catch up with the valuation of where the chart is trading right now. So the earnings report has to deliver, has to show that AMD is still growing even after all of these years and after all of the growth that has been already accounted for. We have two leading indicators from Texas Instruments and Intel's earnings. Both were bad, showing that the chip shortage is hurting these companies. So the fundamental setup is perhaps not so favorable for AMD, because the chip shortage is hurting every single company. But from a technical setup, the consolidation within range is a process of building up energy. And this energy will be released, shall we say violently so, one way or the other. Playing the odds here, you look at the MACD indicator, you look at the RSI indicator, all turning the corner and trending positive once again. In addition, if this stock wanted to go down, it had about a year or so to do so. It did not. It decided to consolidate within range, waiting and waiting and waiting for earnings to catch up with the valuation. If the report comes out decent, my expectations are that if the earnings report is decent, beating expectations, sizably so, I believe that this stock will pop higher out of the consolidation range. I've been eyeing a position in the stock. It is becoming cheapish from certain valuation metrics, the likes of price to sales ratio. But my strategy here is prove it to me first. And therefore, I am following a calendar call spread strategy by selling the 100 calls with the expiration date of this week and then buying the 100 calls for the expiration date of August 20th. All in all, the trade will cost me about $1 a piece. So it is a cheap risk versus reward perspective. If the trade doesn't work, you're just losing $1 a piece. But once again, using the calendar call strategy gives you a lot of time and a lot of flexibility for this trade to work. For example, let's say AMD produces impressive earnings report. The stock pops higher, but not all the way to 100. This is exactly the setup that I'm looking for from this trade. The leg that I'm selling, the 100 leg that I'm selling for this week, will expire worthless, meaning that I will capture the entire premium. And then I can wait all the way till August 20th. If the stock by then is still trading above 100, then I will have the opportunity to buy the stock at $100 a share. In the meantime, I have a few weeks to continue to sell calendar calls and reduce my entry cost for the trade, perhaps all the way to zero, or even getting paid to open the trade, depending on how the stock will trade after earnings. But let's say the stock goes the other way. It goes down 2, 3, 4%. Well, now the trade went against me. Yet I have the time and the flexibility to make decisions here, all the way to August 20th. The technical setup alone looks positive for the chart of AMD. Moving on to another big cap technology stock reporting earnings this week, Facebook. This is a weekly chart for Facebook, and as you can see, Facebook has been consolidating within range for months and months and months. It has broken above the consolidation range, and the breakout is violent in nature. Massive gains, and this is exactly what I'm looking for in AMD's chart. Perhaps the breakout in Facebook needs to push the brakes, because when we look at the weekly setup for the chart, the MACD indicator is extended all the way to the same level where it pulled back before. Likewise, the RSI indicator is within the sell zone. It is so-called overbought, and it is reading at the same levels from which the stock pulled back in the past. When we look at the symmetry of the chart, for example, this is still a weekly chart, by the way, you can see the last time we saw this setup from a candlestick perspective, Facebook took a break, a little dip, and then built on the rally. Facebook remains one of the so-called value stocks within big cap technology names. My expectations here are the stock popped higher on the heels of Snapchat's earnings. But once again, two different companies, two different setup. You cannot compare one with the other. And when the stock moves ahead of time prior to earnings, you risk the phenomena of buy the rumor, sell the news. So looking at the charts, the overextension, the symmetry, my expectations are the stock will pull back slightly, perhaps for a week or two, and then continue to build on the rally because the valuation in this stock is still attractive. Moving on to Ford, this is a weekly chart for Ford Motors. This is also a stock reporting earnings this week. I happen to own the stock in my portfolio, and I started owning the stock back in December, and in this channel I have been an advocate for this stock. It is a value stock, but it is also a play in the EV arena, beside the bloated valuations of, say, Tesla and other players. Matter of fact, I switched to Ford from General Motors last year in December because I thought that GM moved a little too high too fast, and therefore I moved on to Ford, and this has proven to be the correct strategy. We had a descending line in Ford. Once that was broken, all of that energy that the chart of Ford has been gathering for years and years and years, it has been on a descending line since 2015. All of that energy is being released right now. Of course, there is no such thing as to the moon and vertical line rallies. They happen in crazy meme charts, but they are quickly proven to be pump and dump schemes. This chart moved higher, significantly higher, but it had significant pullbacks. And now we're seeing a series of higher highs and, shall we say, higher lows. We still don't have a confirmation that this will be a higher low. But if you're assuming that this will be a higher low, then the stock will continue to move higher. Of course, earnings are critical. The chip shortage is important. Inflation is important for this company. Multiple factors. But from a technical setup alone, what do you do with this chart? The momentum is still strong from a MACD and RSI perspective, but once again, slightly overextended here. And what I'm looking for is a formation of a higher low, and then I will consider adding to my position. Or if some of you don't have Ford in your portfolio, you've been waiting and waiting for an entry point in the stock, if you see a higher low, and this is a confirmation that the trend will continue, and we will see a formation of a higher high, and therefore it becomes a decent point of entry in this stock. But what happens if the stock drops down all the way below 12 once again? Well, now you're risking the development of a head and shoulder formation, which is a bearish formation. So looking at this chart, the best strategy is you wait and see what the stock reaction will be after earnings, and then making a decision whether to buy the stock or not. Here's another chart for MasterCard, also reporting earnings this week. This is a weekly chart, by the way. We have a rising wedge pattern, which is usually a bearish pattern, indicating that once the stock trades out of the wedge consolidation, we see a pullback, perhaps a significant one. We have no bearish indicators from a momentum perspective, Both the RSI and the MACD still have plenty of room to rise higher. But one cannot help but to notice the rising wedge formation. There is still a lot of room to go, a few months or so, before you get to the end of the wedge. But usually charts start to break out of the wedge consolidation prior to reaching the end of the wedge. So we are expecting a move here in MasterCard, and the assumption is that the move will be to the downside. Moving on to another big cap technology stock chart, this time for Amazon. This is a weekly chart, and once again consolidating within range for about a year or so, not doing anything at all. Why? Because the stock already priced in all of these gains and earnings and growth, and now it is waiting and waiting and waiting for earnings to catch up with the valuation. We have a breakout above the consolidation range, but I'm hesitant to say that this is a legitimate breakout. It could be a false breakout, and the next thing you know, the stock drops back within the consolidation range after earnings. Therefore, we need a confirmation this week of the stock popping higher far above the range, and that will create another leg higher for Amazon. The momentum indicators are ripe for the stock to move higher. The MACD indicator has a saucer bottoming formation, indicating that the momentum has a lot of room to go in this stock if it catches a bid. Now, this is the technical setup alone. When you look at the earnings report, the year-over-year growth for Amazon, it will be almost impossible for the company. It's almost a country in terms of valuation, but for the company to beat the year-over-year growth, because last year everybody was locked up at home and we've been buying stuff from Amazon. Well, now we're going out and about and we're shopping outside. In addition, we have so-called shopping exhaustion, where we already bought what we need and then some. So the expectations are that the commerce business for Amazon will disappoint in terms of growth year over year. This is expected. It's not a surprise to anyone. The concentration will shift to the Amazon Web Services growth, which was not that good, by the way, in the last few earnings reports. It was actually being outperformed by Microsoft's Azure and Alibaba's cloud business. So my expectation looking at this stock is it will probably still go back to the consolidation range and trade sideways, because while earnings will be impressive, it is extremely hard to see any growth year over year. And therefore, I believe that this stock will continue to consolidate for a little while, for a longer period of time before it starts moving out of the consolidation range. Moving on to another chart reporting earnings this week, Twilio, the ticker TWLO. This is yet another stock, a high growth stock that has been consolidating and underperforming this year. We have a defined trend for Twilio since last year, a bullish trend. And then as the stock started trading for this year, we know the story. Growth and momentum went out of favor, and value / the inflationary stocks went in favor. And therefore, we saw Twilio trading down for weeks and weeks and weeks. In doing so, forming a wedge pattern. And now it has broken above the wedge, above the descending line of the wedge, which is usually a bullish development. Likewise, looking at the RSI, the MACD indicators, the momentum still has plenty of room to go, and it is turning bullish positive once again. Therefore, the technical setup says, show me the earnings, and if the earnings are good enough, we're ready to go higher here in this stock. You can also argue that we're starting to see a reverse head and shoulder formation. The technical setup for this stock is bullish. Moving on to another stock also reporting earnings this week, in particular on Friday, Chevron, the ticker CVX. This is a weekly chart. We have a massive rebound higher from the bottom, specifically after the Biden election. All of these oil stocks started to move higher. Of course, the geniuses on Wall Street said that once Biden gets elected, it will be the death of oil stocks. They will go extinct, yada, yada, yada. Meanwhile, in this channel, I told you that the election of Joe Biden will be the best thing that ever happened to oil stocks in at least a decade or so. And right away, these stocks popped higher. Chevron, Exxon, even crude oil prices all moved higher. We have a gap since that move in November, and the likelihood is that this gap will not be filled. And the reason is the stock has to go down 30% or so to close this gap. Why would Chevron go down 30% to close the gap? unless we have a disaster regarding the Delta variant and we see oil prices going down severely, then the chart of Chevron will go down, closing the gap. For now, it is pulling back from an impressive move higher. You see the MACD crossing, that was the signal to take profits from that one gigantic leg higher since the elections. And the stock indeed pulled back, but in the process, still making higher lows. And this is what we're watching for. Will this be yet another higher low? And if that is the case, then the bullish trend remains intact. Of course, the stock is trading higher today, but who knows what will happen by Friday. What I'm watching for is the formation of a higher low. If that doesn't happen and the stock starts to go down, forming lower lows, then we get a problem in this stock, a big one. My expectations are when you combine the technicals and the fundamentals, the stock will hold the higher low and move higher after the report. And the reason is oil prices are rising higher and Chevron is concentrated in the upstream business, which has done tremendously, at least this summer travel season. My expectations are the chart will hold the higher low formation, keeping and maintaining the bullish trend higher. Moving on to another stock, Caterpillar, the ticker CAT, also reporting earnings this week, specifically on Friday, surpassing all expectations. This stock has been one of the best performers since the COVID-19 bottom. This is pretty much a vertical trend line with very few stops. It has been trading higher, and every dip was bought in this stock specifically after the election of Joe Biden. But the move has reached extremes, and we saw a massive pullback in the so-called inflationary stocks, reopening stocks as of late, including Caterpillar. The pullback created a bear flag formation. This is playing out, and you see the breakdown below the Fibonacci retracement level. The question is the damage already done? Is the correction already over? When you look at a MACD or RSI perspective, for example, from a weekly chart, there is significant weakness. The momentum is way weaker than it was before, meaning that the appetite for buying the stock is fading away. So the earnings report will be extremely important to re-solidify the thesis that this stock should move higher. Now, I'm looking at the MACD indicator from a weekly perspective. Are we starting to see that the worst in this correction is behind us and we're seeing a saucer bottoming formation? It is too early to say so. Likewise, is the RSI also gathering some energy, readying to move higher? The stock is certainly showing a lot of resiliency by climbing back and attempting to retain the Fibonacci retracement level for support. And this retracement level is at around 210. Now, let's combine the technicals with the fundamentals. We have a massive infrastructure spending bill to come. Trillions and trillions of dollars, which means that this will be a good catalyst for Caterpillar. The main question is all of that already accounted for in the move in this stock? And if that is the case, then the weakness still has some room to go, and the stock will go down after earnings, all the way down to the next Fibonacci retracement level of around 185, 186, and at that point, the stock will be at a buy zone. For now, the stock remains a little too elevated for my taste, and I believe that the bear flag formation still has room to materialize a little lower, meaning the stock going down to 186, 185, and that will be a solid buy signal because 185, 186 is an excellent support. In addition, by that time, the stock will become extremely oversold. Moving on to another chart reporting or reported earnings this week. LMT, Lockheed Martin. I bought the stock in anticipation of a break higher above the descending line that has been going on since the COVID-19 drop. Of course, the stock is trading down by about 3% today, but I view this as an opportunity to buy the stock. It has an excellent dividend, it reported excellent earnings, and it remains one of the safest stocks in the market. The U.S. government, the war addict that it is, will not let Lockheed Martin to suffer financially. But looking at the technicals alone, the stock moved significantly higher off the support of 339, breaking above the descending resistance line. And now it is consolidating in what it appears to be a bull flag formation or a cup and handle formation. Both are positive bullish formations, and therefore I view the dip in the stock today as an opportunity to buy. Yet keep in mind, this is not a trading stock. This is an investor type of stock, meaning that you buy it and you keep it in your portfolio for a long time, with the goal of capturing a safe 3% or so in dividends. Moving on to another chart of EA, Electronic Arts. This is a weekly chart, and this chart is looking extremely bullish here. We have a defined resistance line at around 148. You could go 150 to be conservative, but we also have a rising support line. What does that mean? The chart is strengthening every time it creates a higher low, readying to break above the resistance line once and for all. It has been the resistance line since 2018. It was the previous stop, and now the chart has another shot to break above this stop once and for all. The technical setup for this stock is extremely bullish. Now you have to combine that with the fundamental setup by looking at prior earnings reports and what are the expectations for this upcoming report for Electronic Arts. I'm not sure if they have new releases, which will be a catalyst for the stock to move higher. The Legend of Apes or Apes Legends or whatever you guys are playing, doesn't matter to me. But the stock needs a little more excitement in the next earnings report to break above the resistance line once and for all. But to play the devil's advocate, here it is, the weekly chart of Take-Two, another video games publisher. The ticker TTWO. In this stock, contrary to the formation in Electronic Arts, we're seeing a head and shoulder formation, which is a bearish formation, indicating that the stock will go down, and it will be a sizable drop, perhaps all the way down to the trend line that you see in yellow. Once again, you have to combine the fundamentals with the technicals. Is there anything in Take-Two's earnings that will be disappointing? You have to do the fundamental analysis and combine it with the technicals. You cannot rely on the technicals alone. Usually, not always, but usually, these video game stock trade in synchrony. They go up together, they go down together. But here we have a contrast between two charts. Electronic Arts, bullish formation. On the other hand, Take-Two with a bearish formation. Moving on to another stock, and this time we're using a daily chart for Alcoa, one of the top performers this year. A classic inflationary stock. We have a shortage in aluminum. The prices of aluminum are exploding higher, and therefore we have a great setup, fundamental setup for this stock to move higher. It already moved higher, triple digits, and now what? We're seeing all of these inflationary stocks pulling down double digits, 10, 20, even 30% in certain cases. And the main question is the inflationary trade dead? The answer is, in my opinion, not really, because we still have the fiscal spending to come in terms of infrastructure. So watch out for this name. It's a bullet stock. What is a bullet stock? It's a stock that works when we have pricing wars, when we have severe competition in certain industries. You go back to the source, the provider of the bullets, not the stocks involved in the war. We have an EV war. Well, all of these EV manufacturers need aluminum. We have an infrastructure bidding war. All of these firms will compete to get a contract from the government. Well, guess what? Alcoa provides all of that aluminum regardless of who wins the contract. And therefore, it is a perfect bullet stock. Now, let's talk about the technicals. We have a consolidation range, a descending channel consolidation range after a massive move higher in the stock. This is a bullish setup, not a bearish one, and the stock is already breaking above the consolidation range. We need a confirmation this week. When the confirmation happens, then the stock will move higher, perhaps creating higher highs once again. We see the double bottom formation in the momentum indicators, the RSI, the MACD, indicating that the stock is ready to move higher. The momentum is already bottomed and it is ready to build on again and move this stock higher. My expectations are Alcoa moves higher. And here's the chart of Roku, the ticker ROKU. This is a weekly chart for the name. Take a look at the MACD indicator, for example. In the yellow bubbles I'm highlighting for you. If you have been betting and calling a top in this stock throughout the massive impressive rally since the COVID-19 bottom, you probably got whacked. And the reason is you did not follow the technicals. The technicals were saying this is an extremely strong stock, an extremely high momentum stock. You don't want to bet against it until and unless you see a reversal signal. Well, the reversal signal finally happened earlier this year when the MACD indicator crossed the negative territory, creating red impressions on the histogram. That was the sell signal, the confirmation, of course, because the MACD is a lagging indicator, not a leading one. But disciplined and conservative traders wait for confirmations before initiating a trade. Anyhow, if you used that signal alone, the stock went down all the way to the tune of 50% from the highs. And now, as the stock started to curl its way higher, we saw a crossing in the MACD indicator, creating greed impressions on the histogram once again. This was a signal right there to switch the trade. If you haven't closed it already, you should have closed it as you saw the saucer bottoming in the MACD indicator. But this was a buy signal right there. And if you bought the stock, guess what? It went back all the way to all-time highs. And there is plenty of room for the stock to go higher because the momentum is strengthening once again. Of course, the stock is expected to face some resistance at the prior all-time highs, so you could play a short trade there. But for me, I wouldn't do that because the time for shorting this stock was already back a few months ago when the MACD indicator crossed to the downside. If anything, this is a stock to buy at this point, at least from a technical perspective. Who knows what the fundamentals will show? Who knows what the earnings report would show? But from a technical perspective alone, you don't want to bid against this chart. Here's another perspective, by the way, from a daily chart perspective. Are we seeing a formation of a cup and handle? This is exactly what I'm seeing, and the cup and handle formation is playing out. The stock moves higher, and it will break above all-time highs. You might see some resistance at the prior highs, but the momentum is too strong to create a double top formation. The likelihood is the stock will make new all-time highs. Moving on to a daily chart for the ticker ADM. This is Archer Daniels, one of my favorite stocks, which I've been waiting for an opportunity to buy because this is yet again a bullet stock. If you are betting on food inflation, grains inflation, the rise of commodity prices, this is one of the best plays in that arena, whether you're betting on wheat prices to go higher or grains in general. Finally, we saw a massive correction in this name. Double digits correction. This is a daily chart, by the way, and you can see that the momentum indicators are bottoming. The RSI, the MACD, they're at the bottom. They're at severe oversold conditions. This is a high conviction buy from a technical perspective, at least for me. The name will report earnings this week. My expectations are, at least from a technical setup, this stock should move higher, and I will not hesitate to buy the dip in this stock, at least from an options perspective. Now, what if there is a disappointment in earnings? Hypothetically so. Where will the support be? The next support will be at around 52. And at that point, boy, the stock will be extremely oversold. It will bounce even on technical basis alone. To conclude, I like the stock. The ticker ADM. What about the ticker ADSK, Autodesk? This is a weekly chart. We have a wedge consolidation, and the chart is breaking out of the wedge consolidation in a bullish behavior. It's breaking up higher. We're seeing a significant strengthening in the MACD and the RSI indicators. These are all signs and signals for a bullish setup in this stock to move higher. Of course, we're waiting for confirmation from the fundamentals, but the sister stock for this one is Adobe. Adobe already moved higher, significantly so, a massive breakout, and the expectations are if Adobe breaks out higher, so will Autodesk. Looking at the technicals, my bet is the stock will move significantly higher. Lastly, somebody asked about Discovery, the ticker DISCA. This is a meme stock, or at least was a meme stock, due to the Archegos Capital gambling. I happen to short the stock at the top, not this one, but the sister stock of Discovery, which happens to be Viacom. And that was my best trade going back all the way since the Brexit crisis in 2015. And I wish that I actually shorted the stock, not just via options. What do we do now in this chart? Because there's nothing you can see here. There is no technical significance whatsoever in this chart. And this is a weekly chart, by the way. But the stock did a 180, going back all the way to the prior levels before the Archegos Capital Mania, which makes it back again a value stock. What do we do with this one since the technicals say nothing at all? We follow the fundamentals. I have no doubt in my mind that in the next earnings report for this company, Discovery, you will see that the rate of growth and the momentum in the Discovery Plus streaming service is extremely impressive. These are highly addictive shows provided by Discovery. It's all toxic garbage, but people watch it anyways. Addiction is good when you are a streaming service. You want your customers, your viewers, to be addicted. They need more and more and more supply of these garbage shows, and they're getting them from Discovery Plus. Therefore, my recommendation is If you like the stock, buy it. Don't trade it. Buy the stock and hold it in your portfolio. You will be rewarded in the long term because it went back to being a value stock. But if you want to trade the stock, buying call options with the expiration of this upcoming Friday, then you're a fool. You're going to lose your money. This is a own it stock, not a traded stock. Anyhow, folks, we're done here. Of course, we're not going to do a regular show today because I already did this one. But boy, tomorrow we have an extremely important day for the market. A slew of big cap technology stocks earnings, which will move the NASDAQ and the S&P 500. These are the stocks with the highest weighting in every index out there. What does that mean? It means it is popcorn season. With that being said, ladies and gentlemen, thank you for watching, thank you for listening, and I will talk to you again tomorrow.